The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome everyone to today's webinar titled Making Much More Money with Lean. I am Jerry Strohmeyer, the Education and Training Program Coordinator for AME, and I will be your moderator. Today's presenter is Brian Maskell, President of BMA Incorporated. Brian works with large multinational companies worldwide, but the majority of his time is spent with small and medium-sized companies striving to become truly lean organizations. Brian has been working with lean companies for more than 25 years as an engineer and as an accountant. He brings a very unique perspective to the accounting, control, measurement, and decision-making issues of lean companies. Brian is a conference speaker, blogger, podcaster, and the author of 8 books, including Making Numbers Count, Practical Lean Accounting, and the Lean Business Management Systems. Before we start, just a couple of housekeeping items. You will be in listen-only mode throughout the webinar. You will see that you are muted on your attendee panel on the right side of your screen. If you have questions during the webinar, please type them into your question area in the attendee panel and click on Submit. We will review the questions at the end of today's presentation and answer as many as we can. When you log off today, please check your email inbox, and it will be an invitation and link to fill out a short webinar attendee survey. Please take a few minutes to complete the survey today, as your feedback is very important to us to improve future webinars. Brian has also graciously agreed to provide a PDF of today's presentation. We will be sending that along with the recorded link for a webinar replay to each of you next week. Now, I am pleased to introduce Brian Maskell, who will present Making Much More Money with Lean. Take it away, Brian.
Okay, good afternoon, everybody. Thank you for listening in. And we're going to look at some tools and techniques that you can use to make more money from lean. We're going to look firstly at what are the economics of lean to kind of understand the background here. Then we're going to look at how do you calculate the true financial benefit of lean improvement or changes. There's a lot of misunderstanding on that, so I want to give you a simple approach to doing that. Then we're going to look at 5 ways to make more money with lean and get some understanding of how the financials match to the improvements that you're making. And we're going to wrap up with just looking a little bit at decision making and how you can use decision making to make more money and make more cash and serve your customers better. So that's our agenda for the next 40 or 45 minutes. So let's take a look at this economics of lean. Before we start, though, everything we're doing is based on these 5 principles. The first principle of lean is really focused on how do we create more value for the customer. Working by value streams, we make, manage, measure, and improve by value streams. And then flow. Everything we're doing in lean is to make everything flow faster and flow better. You know, a lot of people say, oh, wait a minute, lean is about taking out waste. Well, of course it is, but why do you take the waste out? You take the waste out because it's the waste that impedes the flow, and it's the flow that we're after at the pull of the customer. Another thing is we want to empower people, and respect for people is what Toyota says, and so we need to have the simple measures that are really going to work for people both operationally and financially. And then we want to pursue perfection. We want to keep doing this until we get better and better at it, and become a truly lean organization that's really making tons of money. So the economics of lean. First of all, it's not about cost cutting. Lean is not about cutting cost. It's a growth strategy. And you know, traditional companies are always talking about, well, you know, how much money we're going to save and so on. That's a good question. You know, saving money is good, but lean is really about growth. Let's take a look at this. The first step is we've got to truly understand the value to the customer, because the more we understand value to the customer, the more we can meet the customer's value, and the more therefore that we can sell to customers and get a competitive edge on that. Then we eliminate waste. And when you eliminate waste, you're going to take away a lot of things that people are doing or machines are doing or other things that are wasteful and don't add value to the customer, and that's going to free up a whole bunch of capacity. Now, if you free up capacity, what are you going to do to that that's going to make tons of money? Well, of course, we're going to design, make, and sell more products. And if we design, make, and sell more products, we're going to grow our revenues and our cash. So that's the fundamentals of the economics of lean. Let's look at a simple example here. Suppose you've got a value stream that currently makes 1,000 units a month, and they're $200 each. Well, here's a mini income statement just below that. Our revenue is $200,000, material cost $120,000, and production is $60,000. So that, do the math here, and you wind up with $20,000 of profit, which is 10% return. Now, as a result of lean improvement, we're getting 20% more capacity, so we can now increase our sales to $1,200 a month instead of $1,000. Then that opens the question, well, what's the cost of that extra 200? Well, the answer, of course, is nothing, just materials, isn't it? Because we freed up capacity that we were paying for anyway, we could make 200 more units for nothing at all. So let's look at the income statement as it looks now. Well, our revenues have gone up by 20%, our material cost has gone up by 20%, but our production costs are still the same. And when I say production costs, that's not just production, but it's the whole organization with all the overheads and all those other things. So now our profit has gone from 20% to 200,000 to 36,000. Now let's look at this then, and this is the big deal. Our revenue has increased 20%, but our profits and cash have increased 80%. This is the economics of lean. Eliminate the waste, free up capacity, and then design, make, and sell more products, which leads to enormous increases in the profitability and cash of the business. And that's what lean is really focused on from a financial point of view. So the economics of lean is not about cost cutting, it's about growth. So who needs to be involved then in deciding what lean improvement you should make? Well, very definitely sales and marketing and product development. You know, I've worked with loads of companies and they seem to think that lean's something to do with the factory, and they do current and future state maps and it's all done by engineers and factory people, but who's going to fill that capacity when you start freeing up the capacity and being able to have a great deal more capacity? The answer, of course, is sales and marketing and product development. So we have to harness this newly created capacity to maximize the financial benefit for the company. So I'm going to give you an example here of how to calculate the true financial benefit of lean change. The reason I'm doing this is that there's quite a lot of misunderstanding about this. It's very common, in my experience anyway, for companies to say, well, it takes us 10 minutes to make the product now. As a result of lean improvement, it's only 8 minutes. So we're saving 2 minutes per unit, and we multiply that by the standard cost, and we multiply it by 12 months. We're going to save $150,000 this year as a result of this improvement. But the annoying thing and frustration for the financial people is that generally none of that will hit the bottom line. And we're then in this sort of conflict where we've saved this, but where is it, that kind of stuff. Because if you think about it, we've done great improvement by taking, what is that, 10% out of the production time, but really we've still got the same machines, we've still got the same factory, still got the same overheads, we've still got the same people. Generally, very little cost goes down. Now, of course, making an improvement might well improve the quality of the product and the quality of the process, really, and as a result of that, maybe our material cost will improve, but by and large, we don't make a lot of financial benefit by lean improvement. What we do is free up capacity. So financial benefits, let's take a look at how you do this. If we've got a current state map, we've got a future state map. This is the improvements that we're going to make over the next 3 months or 6 months, something like that. Now we're going to use what we call a box score. Now the box score shows a three-dimensional view of the value stream. You can see at the top we've got operational performance measurements. So these are the performance measurements of the value stream as a whole. Now, I'm showing some typical ones here. I'm not saying these are the right measurements at all. You know, every company is different and there are different needs. But whatever you decide is the operational measurements that keep track of the performance of your value stream, that's the operational measurements. At the bottom here, we've got a summary of the financial results for the value stream. So there we've got revenue and materials and other costs, and in the value stream income statement, of course, would show a lot more detail, but this is a summary that shows the revenue, the cost, the profitability, and the return on the for the value stream as a whole. Now, the third piece of this three-dimensional view is looking at, are we making good use of our resources? In this case, we're looking, I think, at people time. 69% of the time of our people is spent doing things that are productive. Now, this isn't just the people in production. This is everybody that works in the value stream. How much of their time is spent doing things that we consider to be productive, and how much of their time is spent doing things that are non-productive. And the third one you can see is, well, what's the available capacity? So in this case, it's -1. That means that we're working quite a lot of overtime here because we've got 69% productive and 32% non-productive and no time left over. Rule of thumb actually is you need about, I don't know, 10–15% available capacity to run a controlled operation. So -1 is really pretty bad. But those are the three elements of the box score. Okay, so what are the true financial benefits? Well, the when, why, and how is in the box score. So the box score is kind of standard work for showing the performance of the value stream. Now, how much money are we saving? That's a good question. You know, it's good to save money, and it's good as we do improvement to bring down our costs. However, the better question is this. It's what are we going to do with the capacity that we've freed up? By and large, it's how we use the capacity we've freed up that gives us the big financial benefit of lean. So here's that box score again. On the current state, that's the same as I showed you before, but now with the 3 Kaizen events that we're going to do over the next 3 months or 6 months or whatever your value stream maps are showing, this is showing the changes that will occur as a result of those Kaizen events, and this is the future state. When we've implemented those 3 Kaizen events or done those 3 Kaizen events, this is what the operation is going to look like. Now, if you look at this, this is quite good improvement from the point of view of the operational performance measurements. Productivity is going to stay the same because we've still got the same sales and we've still got the same people. But our on-time shipment is going to improve greatly. Our inventory, which already is quite low, but that's going to go down even more. Our quality is going to improve from 88% to 96%, and the average cost of the product is going to go down a bit. But when we look at the financials at the bottom, there's not a lot to show for it there. Our revenue is still the same. Our material cost has gone down a bit because the improvements we've done have improved some of the quality of the process. Labor costs are the same because we've got the same people. Machine costs are the same because we've got the same machines. And then other costs have gone down a little bit as a result of the improvements that we've made. So this is fairly typical. We've got rather good improvement operationally at the top here, but really not much to show for it financially, quite wimpy actually. So what's really happened? Well, you can see that from the value stream capacity here, that we've gone from -1 available capacity to 20% available capacity. So we've opened up 21% more capacity in our value stream. So the question is, what have we saved? Yeah, we've saved some money. But a better question is, what are we going to do with that 20% capacity that we've freed up? And I've just got 3 examples here that we could look at. When you do this in real life, you come up with 15, 20 different things that we can do here. But let's look at a few typical ones. First is we can move people out of the value stream. move them into another value stream. Now, of course, that means that this doesn't affect the labor costs of the company as a whole, but it does reduce the labor cost of this individual value stream. And sure enough, if we do that, our productivity goes up and our financial numbers go up. So our profit for the value stream has gone from 242,000 up to 285,000, and we've gone to 14% available capacity. So we've got a nice balanced operation there, which is making more money. The next one, though, shows us a better result. You know, you've got people working in product development who are doing a lot of voice of the customer, getting close to the customer, understanding what creates value, and they're actually been working, the company that this is based on, they've been working for several months on designing new products that were specifically focused on addressing the customer's value needs, and so they could also sell those at higher prices. So you can see there that if we introduce these new products, and the company that this was based on, they brought them forward, they put a lot of extra effort into to be able to pull these forward as we created the additional capacity. So you can see there the operational numbers are going up, productivity is much better. Now on-time shipment is going up to 90%, inventory is going down better than before, but first pass quality is not quite as good as before, but only 1% lower. But the average cost has gone down significantly. If we look at the financial numbers, we are doubling the profit as a result of introducing these new products. And we've got about 8% available capacity, so we've still got a fair amount of available capacity to play with based on the changes that we've made. Now, if you couldn't do that, a third alternative is to insource some products that are currently being outsourced. You know, when our capacity was very unavailable, then we outsourced a whole bunch of products, but now we can bring them back because we've got available capacity. And sure enough, that would give us a good result, $291,000 of profit showing down here. So this is the way that we would look at the financial benefits of lean. Not only would we look at the savings, but we would also say, what is it we can do that is going to maximize the financial benefit of the capacity that we're freeing up? So how do we do this calculation of true financial benefit? We want to work out the true bottom line amount of profit and cash. When you look at that box score, that bottom line number is how much money is going into the bank. There's no complicated accounting involved. That's how much money we're making as a result of this, and that's going into the bank. So we want to maximize the financial impact of the Kaizen events that we're doing. So let's move on to looking at 5 ways that you can make more money with lean. And these are I'll go through these fairly quickly, but I think they'll make a lot of sense to you here. Lean, of course, is very different from traditional management, and so the traditional financial information really doesn't work. And so we need to have a different way of looking at the operational and financial impact. So one would be timely information that everybody can immediately understand and use. We want financial and operational information that everybody in the company can just see it and understand it immediately. Another is better information. If we can provide better information, then we can make better decisions, which leads to better revenues, better profit, better cash flow. The third would be to have measurements that motivate people for continuous improvement. If we have measurements that are motivating everybody in the company towards continuous improvement or continuous lean improvement, then we're going to get much better results. The fourth is we want to maximize the benefits of the lean improvement and Kaizen events and kata and the things that we're working on to improve the process. And that's similar to what I just showed you. And then number 5 is, if you take these lean financial approaches, you wind up having a lot less work for the accountants. And we can free up the time for the accountants. The same lean story. Eliminate the waste, free up the time for the people. So in this case, the accountants and other people working in those admin areas will free up their time that they can then use those for more strategic objectives. So these are the 5 we're going to look at. Take a look at the first one, timely financial reports that everyone can immediately understand and use. Frequent reporting. You know, a lot of the companies we've worked with, they report the financial results of the value stream every week. Now, of course, to do that, it's got to be quick and easy to create the reports. We also want to use what we call plain English financial information. So this is information that people can immediately understand and use. No complicated accounting things, no standard costs that give distortions and give you a lot of wrong information. No running by the rear view mirror. You know, we're getting very timely information that enables us to take proactive change within the value stream. So this is a traditional income statement. It's a fairly simple one, but it's very similar to what most companies in the US and overseas as well use. What we've got at the top here is the revenue for this period. Let's suppose this is a monthly number. So our revenue this month was $2 million, and in fact the second month it was about the same. Now we have cost of goods sold. Now I know a lot of you listening in are not accountants, but cost of goods sold takes the standard cost of what we've sold, multiplies it by the quantity that we've sold, and so this tells us the cost of the product at standard cost. I don't think that has any meaning. I don't quite know what anybody would use that for. But the next, though, is gross profit. Now, gross profit is the revenue minus that cost of goods sold. So that gross profit is the profit we would have made if the products were manufactured at standard cost. But, of course, the products never are manufactured at standard cost, and that's why you have all these variances below it. I've only put 4 in here, but a lot of companies have 6, 8, or 10 different variances. So purchase price variance, material usage variance, labor variance, overhead absorption variance. And then below that, we take, so that those variances adjust all this profit stuff. And then below that, we take SG&A. So that's the sales, forgotten what it stands for. Yeah, sales, general, and administrative costs. So those are all those overheads and things that that get added into the product costs. And so that gives us then a net profit of $197,000 out of our $2 million of revenues. Now we've got 2 periods here, and you can see that the revenue those 2 periods is about the same, but the net profit is quite different. And the question is, why? Now, any accountant worth their salt can deconstruct all these numbers and they can tell you why, but most everybody else in the company would have no idea why this is changing. In fact, what I've discovered is that very few people in companies understand any of this accounting stuff, particularly overhead absorption, a very dangerous thing to measure. And purchase price variance, too, is a dangerous thing to measure in a lean environment. But we'll get to some of that later. So what I'm suggesting is that the majority of companies are producing financial reports that very few people in the company understand. Certainly very few people that are working in continuous improvement or working in production. Value stream managers, you know, very often they'll be from sales and marketing or from production areas or something like that. And we're giving them financial information that is very difficult to understand and, in fact, quite misleading. And I'll get to some of that a little bit later. So we would advocate what we call a plain English statement. Plain English statement says, look, at the top, here's our revenues. Now, that's a real number. We sold $2 million of stuff that period. And then below that, we just said, well, what did we spend? Well, this is what we spent on materials, $829,000. This is what we spent on labor, and that's the people making the products, but also the other people in the value stream. The cost of the machines, the cost of outside process, the cost of the facilities that we're in, and then other costs that come into that. And that gross profit at the bottom, $299,000, that's real. That's what's going into the bank. There's no funny numbers here. That $299,000 is the amount of money we've actually made as a result of our operations. Now, below the line, we can do some adjustments here to bring it in line with the what's called generally accepted accounting principles, to bring it in line with the standard approach to accounting. And that is, we've got to make an adjustment based on how much inventory we've changed. So in this case, we've spent more inventory than we bought. And then we also have other allocations that come into play from within the organization. The one I'm showing, there are several, but the one I'm showing here is corporate allocation. So this is what your corporate people charge you for the pleasure of their all the things they do for you. And you can see that the bottom line net profit is the same as the one on the previous page. But we would be working at this gross profit level because that's something that everybody can see and understand. Oh, and by the way, why is the profit quite different in period 1 and period 2? Well, it's obvious now, isn't it? There was a significant inventory reduction. And whenever you reduce inventory, your profit goes down. Now, that's part of traditional accounting that is very harmful to lean, isn't it? You know, in lean, we would expect to see our inventory going down and down and down as a result of taking waste out. And every time you take waste out and you reduce your inventory, it undermines the profit of you that is shown through traditional accounting. So that's what we would look for, is a plain English income statement, and the touchstone of this is, can everybody in the company see this, understand it, and use it? So number 2 then, better information leads to better decisions. So if we have real financial information rather than all this standard costing stuff that gets in the way, then we won't have confusing accounting measures, overheads, absorption. You know, overhead absorption, by the way, is what bankrupted General Motors in 2009. So this is not minor stuff. This is rather significant stuff. But if we can have good information, then people can make better decisions. Let's look at a simple example here. So this company, they make valves, and they've got a customer that's prepared to pay $45 for this particular valve, ProValve 602, and the company has a policy of 15% margin is a minimum that you can take. They're very traditional stuff. Now, the standard cost is $42.34, so the margin is less than 6%. So are we going to take the order? No. Not so fast, says the purchasing guy. Maybe we can source this overseas. Well, sure enough, we can do that. We can source it for $33 a unit in a Far East supplier. Now, this company recognizes that there's additional overheads associated with outsourcing overseas, so they add another $2.48 to take account of the additional overheads for doing this. So that gives us a total landed cost of $35.48. Our margin is $21. So should we take the order? Yes. Now the purchasing guy is about to pick up the phone and place an order for a boatload of these, really a boatload, when the value stream manager says, wait a minute, not so fast, maybe we can make this in-house and make a decent amount of money. So should we do this? Well, let's take a look. Well, now, here's our current state prior to taking this order. Here's what's going to happen when we take this order, but we've got to hire a couple more people, and we've got to buy a couple more machines. So add those across, and this would be the financial impact on the value stream. And sure enough, our value stream would go from a 17% return up to a 20% return. $242,000 profit up to $312,000. So let's put the three of these together. Here's our current state when prior to taking on this order. Here's what it will look like if we work this on a standard cost. It will be exactly the same because we wouldn't take the order. Here's what it'll look like if we go to a low-cost country, and here's what it'll look like if we make it in-house. Now, all we're doing here is just presenting the same information, but presenting it in a way that gives you the true bottom line result. That $312,000 is what will go in the bank as a result of taking on that new order. Now the question would be, well, how does your company work this out? In lean accounting, which is what we call all this stuff, then this information would be very clear and straightforward, and you'd be able to make a better decision. A better decision leads to better revenues and better profits. Number 3 then, the right measurements that motivate everybody to continuous improvement. Well, we need good lean measures, we need good lean financials, and those will motivate people to do the right thing. Traditional accounting will measure efficiency. Now, efficiency actively works against lean. You know, if you say to someone, we want you to be efficient, what are they going to do? They're going to build big batches, they're going to make things out of sequence to maximize the changeovers, all of those kinds of things. Similarly, if you say, we want to bring the inventory down, well, there'll be resistance to that because that will undermine the profit of the business. Overhead absorption. What do you do if you get to the 3rd week of the month and you haven't absorbed enough overhead? You do what General Motors did. You just keep making cars that you know you can't sell. And what is that? That's overproduction, isn't it? And eventually, General Motors did that month after month, week after week, until they ran out of money. That's what caused the bankruptcy. And so these are very dangerous measures, these traditional measures. And we need to have good lean measures, both operational and financial, that will lead to the right behaviors. Number 4 is maximizing the financial benefits of lean. And that's what I showed you before. We want to maximize the benefit of Kaizens. We want to show what the financial reports look like, and we want to understand how we can create more value and grow the business using the lean improvements that we're making. Traditional accounting has a lot of difficulty showing that. In fact, most companies go outside of their system to try and work out what is the financial benefit of what we're doing. And that begs the question, well, if we've got to go outside of the system to work out how lean is helping us, then really we've got a system that is unhelpful. Number 5 then is, if we take this lean approach to the financial reporting, it's just a lot less work. I was talking to one of our customers. We've been around for a long time. It's a large multinational with lots of divisions, but this particular division in South Carolina, I was talking to him 3 weeks ago, I guess, and the financial controller said that 50% of his work has gone away because of the simpler information, because he doesn't have to go to all the meetings to explain it. He doesn't have to spend a lot of time working with people who come back and ask a lot of questions because the financial information is clear and understandable. Plus, it's a lot less work because we are doing the financial reporting by value stream, not by departments, not by individual products. It's a much simpler and more straightforward way to do this. So what does he do with his 50% of his time? Well, he's working on strategic purchasing, and he's also now officially a lean leader, particularly in the admin area, but also in the production. So we've eliminated waste, freed up his capacity so that he can do things that are strategically important to the company. And that's what we're after. Now, I don't want you to misunderstand me. I'm not bad-mouthing traditional accounting. You know, it's done us good for a long time. But it was designed for 1920s mass production. It's also designed for top management and Wall Street, you know, how to produce the information that goes outside of the company. None of this stuff is bad, but the effect of it is actively anti-lean. And that's why we need to do something that's really quite different. Now, another thing about lean accounting is that it frees up a lot of people's time. It gets them, that means then that, I'm sorry, stumbled on my words here. Another thing about lean accounting, though, is that we can move decisions to a lower level. So if decision making is easier and straightforward and standardized, then we can have people make decisions at a lower level within the organization. Now, why is that good? Well, they're closer to the work, so they'll understand it better. It frees up the time of the more senior people. So again, we're eliminating waste and freeing up capacity, but now for the more senior people in the company so that they can work on more strategic things. They can work on how can we create more value, how can we grow the business and do the things that we're looking to do. So making much more money with Lean. 5 ways I've showed you, gone through it rather quickly, but I hope it makes sense to you. Traditional accounting really doesn't work in a Lean environment. At best, you ignore it. But value stream accounting gives you much better information. And what's more, this isn't a one-time gain. You know, Lean companies that are working this way, year after year, they're eliminating waste, freeing up capacity, designing, making, and selling more product. And this is what leads to unprecedented growth in revenues, profit, and cash. And then what do you do if you get a whole load of cash? Well, that means you can grow the business in different ways. Introduce new technologies, attack new markets, acquire new companies. These are the things that make companies like Wiremold and Toyota and Danaher and these kind of powerhouse Lean companies. This is how they approach the financial operation of their business. Lastly then, I want to just take a quick look at decision making and how we can maximize profit and cash through better decisions. Now there's a whole bunch of tools that we take into account here. You can see on here A3s and value stream maps. We've got box scores over here. We've got performance measure reports. These are obeyer rooms for the executives of the team. It's blending together a lot of these things that enable us to make better decisions. And it's learning to see. In this case, seeing operationally and financially. So here's a quick example. We've got a value stream that currently has an average price for the 400 or 500 products that are made in the value stream. The average price comes out to about $22.53. The average cost of these products is about $17.92. So every time we sell one of these, on average, we're making $4.61. Now, a large company in your industry, they've come to you and they say, look, we want to distribute your products in a very large new market, but we only want to pay $15 a unit. And the question there is, should we take this business? They reckon that at this $15 price tag that will sell 14,000 units a month, which to you is 20% increase in your demand on that value stream. Now, of course, if you look, the average cost in the value stream is $17.92. The price they're going to pay is $15. So this is negative margin. People will start saying, you know, every time we sell one of these, we're putting, you know, $3 bills in every box, that kind of stuff. But how should we look at this? If you looked at it traditionally, what is the margin? Of course, this is a bad business. But let's look at it from a Lean perspective. Now, when I say a Lean perspective, we never look at the individual item because it's not the individual item that we're actually making and selling. What we're making and selling is everything in the value stream. So we need to look at what is the impact on the value stream as a whole rather than the individual item. So there's our current state that we had before, and now here's the impact then of adding those 14,000 units. And you can see that add those 14,000 units, our operational numbers are going to greatly improve and our financial numbers are going to greatly improve. Now why is that? Well, we've got enough capacity to do this, and so therefore we're not going to need to add any more people, but we are going to work some overtime. So you can see in the financials there that our revenue goes up rather substantially. Well, it goes up by, 14,000 units at $15 each, and our material cost goes up, but our labor cost also goes up a bit because we've got some additional overtime to cover this demand. And sure enough, our profit then goes from 322,000 a month up to 386,000. So that's good business. Now, of course, there might be all sorts of other reasons, business reasons that you would take into account to make a decision like this. But just looking at it from an operational and financial number, then this is good business. So this will give you real bottom line results. I keep saying this, I know, but it's very important. That additional $44,000 is an additional $44,000 going in the bank. There's no accounting witchcraft involved in this. So look, if that's good business, what if we go with a $2 price? Sorry, a $12 price. You know, we can do all sorts of what-ifs with these box score calculations. So now we're going to say, well, what if we bring the price down to $12 a unit? Well, we can double our additional sales from 14,000 to 28,000 based on the market research that we've done. So how does that look? Well, we need to hire 12 more people, and we need to hire 2 more planners. We've also got to buy 6 more machines, but our capacity is looking good when we've got those additional people. This is a much better, much more balanced capacity process here. But look at what's happening. As a result of those additional costs, our profit's actually going to go down. So we're not going to do that. $12 is cutting too slim on this. Yeah, but you know, the engineers come along and they say, well, now if we do this, it means 40% of the demand in that value stream is going to be coming from these products. Instead of buying 6 new machines and hiring a whole bunch of people, why don't we automate those processes so that we can be much more effective in the way that we make them? And sure enough, we could do a what-if on that, couldn't we? You know, if we have 28% here, 28,000 units at $12 each, what's going to happen, though, if we have these automated machines? And you can see here that we're going to get excellent results operationally. Capacity's laid out quite well, although we've only got 6%. That's probably not quite enough. But our revenue is going to go up to nearly 2 million, the same as before. And this is going to bring our profit a great deal higher. So I'm not saying they should do this or they should do that. As I said before, there's probably a whole lot of other issues they need to take into account. But the box score will show you what will really happen operationally and financially, and taking account of how we use our people's time and our equipment time and other things in our capacity analysis. And we have a standard way of making these rather significant decisions. I've only put 3 what-ifs there. Very often you'll have a whole bunch more. So making more money with lean. If we can make good lean decisions, better decisions are going to lead to better revenues, better profits, and better cash. All of our routine decision making is done with this box score approach. And the box score is standardized, and the way that you make decisions is standardized. You create simple templates that can be used by anybody, and that's how we can put a lot of these decisions at the lower level in the organization where the people have more knowledge, and free up the capacity of the more senior people. We don't need to see the impact, we look at the impact on the value stream as a whole, not the individual product, not the individual process, because it's the value stream that creates the revenue, the costs, and the profits. So we have to look at how's the value stream affected by these changes. And this gives us real operational capacity and financial results. And we can do a whole lot of what-ifs and come up with a lot of innovative ways to approach this. And over time, the box score becomes standard work for everything you do with regard to the performance of the value streams. Not just production either. You may have sales and marketing value streams. You may have new product development value streams and others. If you're in other kinds of industries, you may have educational value streams, or you might have serving bank customer value streams. But the box score is applied in all of these different situations. So that's it, the economics of lean. It's about growth, it's not about cost cutting, and we have a simple way to calculate that. How do we calculate the true benefit of lean? We use the box score to understand that, and it gives us the real bottom line result. And then I just showed you 5, I think, rather straightforward ways of how to have lean financials that drive lean forwards. And why is this? Because traditional financial and operational accounting is actively anti-lean. Not because it's bad and wrong, it's just designed for something else. It's not designed for working with lean. And then how do we make good decisions? Well, we get better decisions which lead to better revenues, better profits, and better cash. So I'm going to hand it back to Jerry, and we're going to take questions. Thank you.
Great. Thank you, Brian. And now we will review any questions. If you do have any questions for Brian, please submit them on the right side of your screen, and I will read them. Brian, it sounds like you are suggesting that we do not calculate item costs for every item. How can we manage our business if we do not understand profitability without a product cost for every item?
Okay, that's a good question. It's getting to the heart of the matter. Yes, when you work with value stream accounting, which is what I've been showing you, it's most of the time it's not necessary to calculate the cost of an individual product. And actually, it's if you look at the way that this is calculated in most companies, it's it's labor time, it's multiplied by labor cost, and then we have overhead that are added in. That doesn't really tell you the real cost of the product. It's just a useful way to value inventory. If you go back to the textbooks that when these methods were developed, which is back in the 1920s, they're really talking about doing these calculations for the purpose of valuing the inventory, and they actually warn against. They say, never use a product cost for calculating a price, never use a product cost for making a decision, those kinds of things. But so by and large, within the value stream accounting, you really don't need to calculate a product cost. Having said that, there are some simple methods for doing that are easier than doing it the traditional way and actually give you slightly better results. And so those are available if you need it. We've worked with a lot of companies on this, and if you go through and make a list of what is the reasons why you use a cost of a product, most of them can be eliminated because of the way that the sort of lean approach to accounting works. But very often there's one that holds out, which says if you're exporting product across a country border, then very often you have to give a product cost on the manifest. And so that's why we have a simple method for calculating product costs that doesn't take so much work and gives some valid information. You don't need it for valuing inventory. There are simpler ways to value inventory than doing that. I don't know. I hope that answers your question.
Okay, great. Thank you. We have another question. How do the lean financial concepts apply to a value stream in a finite market?
Okay, I don't actually understand that question. Can you say it again?
Sure. How do the lean financial concepts apply to a value stream in a finite market?
Okay, I'm assuming that a finite market means that you're saying you cannot grow, and that there's a finite capacity, a finite level of demand.
Right.
And yeah, well,
right. A market with little or no growth opportunities.
Yeah, yeah. Well, that's not a problem really with value stream accounting. It's a problem with applying lean in that kind of market, isn't it? And there are no simple. I can give you some kind of simple off-the-cuff answers, but they're not very helpful. But one of them, of course, is then you're in the situation of as you do more lean, you've got to eliminate capacity. You can't use it to grow, so you have to eliminate it. And that puts you in a very difficult situation because, who are the people that will be eliminated? Well, they'll be the people that are working in your company. Who are the people that you need to work on lean? It's the same people. And so it's very difficult to work that way, to say, well, I want you to work hard to make lean a reality in our company. And by the way, you or your your buddies are going to be laid off and out of a job. So that's the problem. Now, if you read the books about wire mold, and particularly the one that Art Byrne, the president, has recently written, what they did in the very early days was immediately when they started doing lean, they worked out how many people that they would need when Lean had been implemented well within their organization, and they did all the layoffs before they started Lean. Now that's a very confident thing to do and a very risky thing to do, isn't it? But that's what they did. Now the third overly simplistic answer is that if you're working in a market that does not have growth, then use Lean to free up the people, particularly the people involved in product development and product marketing, and develop new products and new markets so that you can then go into other industries which do have a growth potential. Now, I said these are easy things to say and difficult things to do, I know, but that's the best I can do on that one.
Okay, thank you. And then it looks like we have one more. Do these different ways of reporting financial information line up with GAAP, the generally accepted accounting principles?
The answer is yes. Do I need to say any more? But I know there's a lot of people in the audience who are more lean and continuous improvement people rather than accounting people. But generally accepted accounting principles, these are the standard methods for doing financial and operational accounting in companies, and they are endorsed by the accounting institutes and so on. And the kind of accounting methods that I've shown you today are all completely in line with those generally accepted accounting principles. And we have customers in the US and Canada and Mexico and Europe and China and Australia who all do all of their accounting using these simpler lean methods, and they have none of the old methods. Now, of course, accountants are very cautious people, so you take it step by step. We're not yanking out the traditional measures until we've really proven that what we're introducing is going to do a good job for you. But it's completely in line with GAAP and external reporting and tax reporting and all of the other things that your accountants have to do.
Okay, great. Well, I don't see any more questions, but thank you everyone for your questions, and thank you, Brian, for a very insightful presentation. This brings our webinar to a close. Our next webinar is scheduled for August 21st, titled Migrating from Batch to Continuous Improvement. Please visit ame.org webinars under events for more information and to register. And don't forget to fill out the short survey that will be in your inbox. One of the benefits of being an AME member is the benchmarking community of practice, which is found on the AME website. Please feel free to review the benchmarking archive library and to use the query system to add queries and receive responses within the community. Go to the BCOP query system found under the Education and Training tab on the ame.org website. Thank you everyone for attending, and have a productive day.
Thank you from me as well. Thank you.